Hello everyone. Welcome to our group's presentation. Today we will present our advanced project, which topic is derivatives market. So, let's start. The content has 4 parts. First is overview of derivatives. Second part is types of derivatives contracts. Third part is features of derivatives. And last one is derivative valuation and why is it risky. Let's move to the first part, overview of derivatives. Firstly, we will find out what derivative is. A derivative is a financial security with a value that is reliant upon or derived from an underlying asset or group of assets, a benchmark. The derivative itself is a contract between 2 or more parties, and the derivative derives its price from fluctuations in the underlying asset. The most common underlying assets for derivatives are stocks, bonds, commodities, currencies, interest rates, and market indexes. These assets are commonly purchased through brokerages. There are 4 kinds of participants in a derivatives market: hedgers, speculators, arbitrageurs, and margin traders. Hedging is when a person invests in financial markets to reduce the risk of price volatility in exchange markets, i.e., eliminate the risk of future price movements. Derivatives are the most popular instruments in the sphere of hedging. It is because derivatives are effective hedges in correspondence with their respective underlying assets. Speculation is the most common market activity that participants of a financial market take part in. It is a risky activity that investors engage in. It involves the purchase of any financial instrument or an asset that an investor speculates to become significantly valuable in the future. Speculation is driven by the motive of potentially earning lucrative profits in the future. Arbitrage is a very common profit-making activity in financial markets that comes into effect by taking advantage of or profiting from the price volatility of the market. Arbitrageurs make a profit from the price difference arising in an investment of a financial instrument such as bonds, stocks, derivatives, etc. Last participant is margin traders. In the finance industry, the margin is the collateral deposited by an investor investing in a financial instrument to the counterparty to cover the credit risk associated with the investment. The most important tool for risk management is the use of derivative securities. For an investor, one of the most obvious ways to reduce financial risks is to hold a broadly diversified portfolio of stocks and debt securities, including international securities and debt of varying maturities. However, sophisticated investors and analysts are demanding that derivatives can also be used to reduce the risks associated with financial and commodity markets. Originally, derivatives were used to ensure balanced exchange rates for goods traded internationally. Today, derivatives are based upon a wide variety of transactions and have many more uses. Derivatives can be used to hedge a position, speculate on the directional movement of an underlying asset, or give leverage to holdings. Their value comes from the fluctuations of the values of the underlying asset. There can, however, be a downside to the use of derivatives. Hedging is invariably cited by authorities as a good use of derivatives, whereas speculating with derivatives is often cited as a bad use. Most would agree that the typical corporation should use derivatives only to hedge risks, not to speculate in an effort to increase profits. Hedging allows a manager to concentrate on running his core business without having to worry about interest rate, currency, and commodity price variability. However, big problems can arise if hedges are improperly constructed or if a corporate treasurer, eager to report relatively high returns, uses derivatives for speculative purposes. So, why do we need to learn about derivatives? Derivatives can be a useful tool for businesses and investors alike. They provide a way to lock in prices, hedge against unfavorable movements in rates, and mitigate risks, often for a limited cost. In addition, derivatives can often be purchased on margin, that is, with borrowed funds, which makes them even less expensive. However, on the downside, Derivatives are difficult to value because they are based on the price of another asset. Most derivatives are also sensitive to changes in the amount of time to expiration, the cost of holding the underlying asset, and interest rates. These variables make it difficult to perfectly match the value of a derivative with the underlying asset. Derivatives contracts help in reducing risk by transferring the risk associated with the underlying asset to the party willing to take that risk. There are four main types: forward contract, futures contract, options, and swaps. First, look at forward contract. Forward contracts are agreements in which one party agrees to buy a commodity at a specific price on a specific future date and the other party agrees to sell the product. Goods are actually delivered under forward contracts. Goods traded can be grains, precious metals, natural gas, oil, or even poultry. A forward contract settlement can occur on a cash or delivery basis. Unless both parties are morally and financially strong, there's a danger that one party will default on the contract, especially if the price of the commodity changes markedly after the agreement is reached. Forward contracts do not trade on a centralized exchange and are considered over-the-counter (OTC) instruments. While their OTC nature makes it easier to customize terms, the lack of a centralized clearinghouse also gives rise to a higher degree of default risk. As a result, forward contracts are not as easily available to the retail investor as futures contracts. The second type of derivative contract that is mentioned is future contract. Futures contracts are financial derivatives that oblige the buyer to purchase some underlying asset, or the seller to sell that asset, at a predetermined future price and date. Here, the buyer must purchase or the seller must sell the underlying asset at the set price, regardless of the current market price at the expiration date. A futures contract allows an investor to speculate on the direction of a security, commodity, or a financial instrument, either long or short, using leverage. Futures contracts detail the quantity of the underlying asset and are standardized to facilitate trading on a futures exchange. Futures are also often used to hedge the price movement of the underlying asset to help prevent losses from unfavorable price change. Both forward and futures contracts involve the agreement to buy or sell a commodity at a set price in the future. But there are slight differences between the two. First, futures contracts are marked to market on a daily basis, meaning that gains and losses are noted and money must be put up to cover losses. This greatly reduces the risk of default that exists with forward contracts. Second, with futures, physical delivery of the underlying asset is virtually never taken. The two parties simply settle up with cash for the difference between the contracted price and the actual price on the expiration date. Finally, futures contracts are generally standardized instruments that are traded on exchanges, whereas forward contracts are usually tailor-made, negotiated between two parties, and not traded after they have been signed. Third type of derivatives that we want to mention is options. Options are financial derivatives that give buyers the right, but not the obligation, to buy or sell an underlying asset at an agreed-upon price and date. Therefore, it is different from future, because the holder here is not required to buy or sell the asset if they choose not to. In order to form the basis for a wide range of option strategies designed for hedging, income, or speculation, we have call options and put options. Call options allow the holder to buy the asset at a stated price within a specific time frame, while put options allow the holder to sell the asset at a stated price within a specific time frame. To induce investors to issue an option and thereby obligate themselves to make a disadvantageous trade, option holders must pay a premium to the option issuer based on the option type, strike price, expiration date, interest rates, and volatility of the underlying asset. And one more derivative to remember is swap. A swap is an exchange of cash payment obligations, which means one party will exchange the values or cash flows of one asset for another. Some types of swap can be listed are interest payment swaps, currency swaps, credit spread swaps, equity swaps, commodity swaps. Swaps occur because the parties involved prefer the other's payment stream. For example, regarding the case of interest payment swap, a savings bank might agree to give $100,000 per year to a finance company in exchange for the finance company's promise to pay the savings bank $1 million times a variable interest rate such as LIBOR. Such an agreement would buffer the bank against rising interest rates while protecting the finance company from lower ones. Regarding features of derivatives, we have hedging with future, security price exposure, and commodity price exposure. The first one is hedging with future. This is one of the most useful tools for reducing interest rate, exchange rate, and commodity risk. Futures contracts have two classes of commodity futures covering oil, various grains, oilseeds, livestock, meats, fibers, metals, and wood. Financial futures, including treasury bills, notes, bonds, certificates of deposit, euro-dollar deposits, foreign currencies, and stock indexes. How future contracts work? Let's consider the CBOT's contract on treasury bonds. $100,000 of a hypothetical 6% coupon, semi-annual payment treasury bond with 20 years to maturity. Settlement price was 116.531250% of the $100,000 contract value. So the price at which one could buy treasury bonds to be delivered in March was $116,531.25. The contract price increased by 19/32 of 1% of $100,000 from the previous day. So if you had bought the contract yesterday, you would have made $593.75. There were 43 contracts outstanding. Therefore, total value equaled $5,010,843.75. The next one is security price exposure. All investors are exposed to losses due to changes in security prices when securities are held in investment portfolios. Firms are exposed to risk if they use floating rate debt to finance an investment producing a fixed income stream. Risks can often be mitigated by utilizing futures and swaps, two types of derivatives. Regarding futures, it is used for both speculation and hedging. Let's take an example. Rising interest rates and commodity prices can hurt profits, as can adverse currency fluctuations. If two parties have mirror image risks, then they can enter into a transaction that eliminates risk. Regarding swap, major changes have occurred over time in the swaps market. Particularly, two effects of standardized contract are lowers transactions costs and increases swaps markets liquidity and efficiency. In addition, international banks make markets in swaps and offer quotes on several standard types. Such changes make swap market more operationally efficient. The last one is commodity price exposure. Futures markets were established for many commodities long before they began to be used as financial instruments. Taking an example, in May 2010, Porter foresaw a need for 100,000 pounds of copper in March 2011 for use in fulfilling a solar power fixed-price contract. A strike could raise the copper's price in world markets, turning the expected profit into a loss. Instead of buying the copper needed to fulfill the contract, which incurs substantial carrying costs, the company could hedge against increasing copper prices in the futures market. Hence, hedging in the copper futures market locks in the cost of raw materials and removes some risk to which the firm would otherwise be exposed.
Section for exploring the answer for the question, is derivative risky? Our team have found that there are four important risk components of using derivative. The first is complexity, the second is leverage, the third is legalized gambling, and the last is sensitivity and volatility. Come to the first, this is the most dangerous because it is impossible to know any derivative real value. The reason for this is it based on the value of one or more underlying assets, and hence its complexity makes them difficult to price. Some analysts use the Black-Scholes model for valuation, but the concept behind is extremely academic and complicated. Obviously, it will be very time wasting. The second is leverage. As we learned in derivative contract, and especially in the forward contract and future contract, now the future trader are required to put 10% of the contract to the margin account to maintain their ownership, or we can say their position. If the value of underlying asset drop or going up, they must add money to the margin account to maintain that position. And if it keep dropping and they keep putting money, uh, over time it could result in an enormous loss unconsciously, and it's really dangerous. The third is the legalized gambling. It is owing to the nature of trading in financial market. Derivatives are often criticized for being a form of legalized gambling. And the last is the sensitivity and volatility of the market. Since it is hard to evaluate the derivative contract because of its high volatility, and it depends on it's very sensitive to small change in many variables such as time, we can say that is expiration period, interest rate, and many more. This makes the market of derivative is highly volatile in nature. So this is the end of this section.